All right, so in developing a risk case, some ways to think about constructing that risk case might be to think historically around what has been the trough PE ratio, either on an absolute or market relative basis. What have been the trough EBITDA ratios of the business? Where have the fundamentals troughed? So where have the margins or revenues troughed in the past? And what is the liquidity situation? And so a business that is self-funded, that's generating cash flow, will have a less severe risk case than a company that has capital markets dependency. If a company that's not profitable, right, trying to analyze what the cash burn in the bear case versus the balance sheet cash currently is, so what's the cash runway for the business? You could look at EV to revs or EV to GP multiple, although those multiples tend not to be as reliable of a downside indicator as free cash flow multiples. You can think about asset backing and M&A backing, but again, generally for unprofitable businesses, the backing, the downside protection is not as real as a business that is generating real profits, real cash flow. So when you think through an NTMPE chart like this, if I was thinking through the Abbott risk case, right, the process might start thinking about a PE range for a trough in this 15 to 18 times, right? We've observed that trough PE ratio actually materialize in the past. And so if we're thinking about a scenario where a risk case can hit, right, that historical prior provides a reasonable basis for thinking about where the multiple could go in the future. I also like to think about a probability tree in certain situations. And a probability tree reflects the reality that equities are not binary. Often they're multiple scenarios. And there's really a view, I've heard a view from a number of the stocks reflect probabilities, right? And a probability tree can highlight where the market price is too optimistic or too pessimistic. And so if you're thinking through a number of different cases, just five sample cases, bull case where there's a takeout, or standard bull case, base case, bear case, disaster case, right? You can construct these individual nodes, right? Then assign your best guess of probability to those individual nodes, right? The probability adjusted stock then becomes the sum product of the probability times your target case, right? And that will tell you what your probability adjusted outcome of the situation is.